Double dip recession. Not even a death penalty can enforce price controls. Hi, everyone, and welcome to another episode of Insights, brought to you by Ainslie Bullion and the Gold and Silver Standard. Today, we welcome back Sam, and that's quite a title there today, Sam. Not even a death penalty can enforce price controls. So very keen to dig into this one with you this morning. How are you going?
Good. Thanks for having me back, Chris.
It's an interesting title. You mentioned really you're talking about this idea of a double dip recession, and it's so interesting actually looking at this because you've got some people who argue we've never been in a recession yet. I tend to fall in the camp that we've certainly had a lot of the elements of recession already go on, and it was only technical explanations describing that we weren't in a recession really for the last several months. But you mentioned the term double dip recession in today's article. Can you maybe give us a little bit of background around that? Is that something that's an established sort of theory?
Yeah, it is. It's not just something that's made up. Some people call it a W-shaped recovery. Obviously, a V-shaped recovery is really strong recovery where things bounce right back. But a W-shaped recovery just means the worst isn't over, and maybe people are a little bit premature in a bull market. So if you look back in the 70s, when inflation went from 2% up to 13%, they actually had to push the federal funds rate up to 18% to reduce the money supply enough to create that recession in 1980. And then it was a surprisingly short-lived recession, and a recovery started right away, basically that year. But then the very next year, they pushed it even higher again to 19%, and we had the surprise second dip in 1982.
So it's something we've seen in the past, and certainly this time is confusing a lot of people because we haven't seen. Well, it's a hard one to get your head around because we have actually seen significant pullback, which is kind of what you're saying, that we've seen that pullback and we get the bounce back up and then have that second leg lower. But there seems to be a lot more confusion than usual. But every major economic move typically has warning signs around it. So what are you looking at to detect this idea of a double dip recession as opposed to that it's blue skies and a bull run from here?
Yeah, so a lot of people would love to believe it's a bull run from here, and then other people want another recession so they can buy in more whatever they want to buy into, whether it's metals or the stock market or a crypto. But there are some specific warning signs, and one of them is we had a really early recovery from this big dip, but there's been lowered production. So if you look to China, I know we had articles about it on the website as well on the Ainslie website, that China's having trouble, raising their production numbers. And why is that? Because the rest of the world's not buying. And that goes back to inflation. The second reason is high inflation. So high inflation is also another reason for a double dip recession, where inflation's too high. People just aren't going to go out and be able to buy as much stuff. And that goes full circle with people not being able to buy as much stuff as they were before, leading to lower production, leading to more economic downturn.
It's really interesting that you mentioned China there, because that was something that Alex was talking about specifically with youth unemployment being just a massive problem. And I can really see that cycle you're describing playing there. If you don't have people buying, then the factories aren't putting on, or it's not even factories, it's all of that right the way through the production process, and not putting on these people coming out of university with the new skills because they just don't have positions for them. So it is a real problem.
Yeah, and look, if China is struggling, and China is pretty much one of the only countries in the world that's doing easing right now, that makes you think what are other countries going to do? And these are the countries who can't buy things from China. So
yeah, because it's a two-way flow. You need the money still coming in. I suppose
exactly.
the interesting point that I'm want to dig into a bit deeper from what you're saying here is this idea of raising rates to solve the problem. Can central banks really raise rates that much more? Because you're sort of implying that they did in the past, but is that a possibility here?
Well, look, according to them, they've all been talking this week. They all say they're going to keep the option open for raising rates. Now, they did do that before in the double dip recession, and they just raised it a tiny bit more and caused that second dip that we were talking about. Now, if they do it now, it might not even matter if they do it, as long as they convince people that they're going to do it, that can have the same effect. You might remember before when they were saying, if you keep buying up the stock market, essentially, we're going to have to raise rates. We're going to have to make you stop buying it. Because essentially what the interest rates are meant to do is make people stop speculating that the market's going to go up. But if bond traders are calling their bluff and everyone's calling their bluff and they're buying it anyway, their actions don't really have too much power, or at least they take longer to take effect. So they do at least need people to think they're going to keep raising rates. Essentially, they want the market to stop being so overheated, is what it seems like.
That's a really good answer, because it sort of appeases me a little bit there to say it's as much about jawboning as anything else, getting that idea out there that they are going to continue, because the reality to me, the maths just doesn't add up. I go, you can't, when the debt is so large, you can't continue to raise the rates, because then it actually becomes problematic, where you've got the interest on the debt requiring more debt, and you really can end up in quite a negative debt inflation spiral, and that's how you end up in a hyperinflationary environment as well. So I suppose what you're saying there is really the answer, that they want to have the illusion, they want to get the benefits of raising the rates without actually doing it if possible.
Well, that's exactly what happened in the 80s as well. Hyperinflation was a big concern. There was a big section of the population that thought they weren't going to do anything. They weren't going to raise any more, add any more pressure to the economy. They were just going to go full hyperinflation in the 80s, and that would be end of the US dollar within a few years.
Yep.
They didn't. They just nudged the market a little bit further to cause it to correct, and then restarted the cycle, essentially making inflation worse than ever, but giving a bit of a reset.
Yep, that makes sense. So let's assume you're right here, and we do get this W-shaped double dip recession. How do you think people react to that? How do banks react? How do politicians react? Because obviously that is going to catch a lot of attention. People think maybe if they think the worst is over and then they think, oh, we're heading back into it, it's going to cause a lot of angst amongst the general population, you would think.
Yeah, well, the first time or not the first time, but the most recent time in the 80s, there was a lot of trouble from the general population saying, what are you doing? You're essentially purposely crashing the economy, which may have been necessary. But then afterwards comes the big problem, because it's just sweeping dirt under the rug, really, because how do you get out of a recession when you start easing monetary policy again? And what does that do? It makes inflation many times worse again. Yep. So what did they do? Well, one thing that Nixon did was he closed the gold window. He tried to get everyone to say, don't look at the price of metals, just look at the US dollar in terms of other currencies. Let's just compare apples with apples here, or rotten apples with rotten apples.
Better analogy.
And then the next thing they can do is try to attempt price controls. And that's not anything new. That's something they've been trying to do since the Roman Empire, potentially earlier. And that's why I mentioned in the article today, not even a death penalty can make people follow price controls. This is, the Roman Empire, and the emperor was saying, here's a list of over 1,000 goods. You're not allowed to charge more than X amount for these. And it was essentially just ignored, because all the pressure was put on the merchants, calling them the derogatory name of speculators. They're just doing supply and demand with the money the government's given them. And yet the government kept debasing the currency. So what did they do? Well, they had to charge more. They had to travel other places where they could get more money for their goods, and they had to adapt. So even in the face of a death penalty, pretty much no one followed along. And within a couple of years, the edict he delivered just kind of faded away. So price controls could be attempted, but if history goes the way it's gone for thousands of years, they won't work at all.
Yep, and you can really see the reality on the ground overriding the edict from above, can't you, in that scenario? Because ultimately you've got to put food on the table. You've got to do what's right for you and your family. And even back in those times, that would have been the case. So the threat of death wasn't enough. And yeah, it's interesting. It's very interesting. So do you think you've mentioned gold specifically in the article as well, down the bottom, saying this idea of getting people to ignore it effectively. Can central banks do that? Can central banks just get people to ignore gold by bashing it down, effectively trying to keep it off the radar? Or is it similar to the story you just told, where you can say these things, but the reality on the ground is people realize they need it and they keep, they see through that and do what's in their own best interest?
Yeah, well, around the 2008, the GFC, Ron Paul was famously questioning Ben Bernanke, saying, does gold have any value? And Ben Bernanke was essentially responding no, with a smirk on his face. So they can try, but one thing that would help is if they stopped buying record amounts of gold themselves.
Yeah.
That's one
pretty
thing
hard to convince people that there's no value there when you're buying it hand over fist, isn't it?
Yeah, like we talked about the other week, they're buying record amounts of gold, and then they're trying to tell people we're going to tackle inflation. What's kind of scary if they're saying we've got it covered, we're going to do this, but then in the background, or actually in the foreground, really, they're buying a huge amount of gold. So that just shows that they're buying it themselves because they don't see any other option. And gold and silver have been around for thousands of years. They've never gone out of business because they can't go out of business. It's just it's just commodities. It's just money, essentially. And the central banks know that. So, again, do what they do, not what they say.
100%. Well, Sam, thank you for all of that today. A great in-depth dive into what's going on and what we can expect, certainly from your perspective, of that we get this second leg down. It's something we can all find quite interesting and be on the lookout for. So thank you for that.
Thanks, Chris.
Thanks everyone for watching. If you have any questions, pop them in the social channels and we'll incorporate them and get back to you on those as soon as we can. That's us for this week on Insights. We'll be back next week to discuss all things markets and metals as we do. So until then, have a great rest of the weekend, everyone.